All right, yield nerds. Hope everybody had a good Thanksgiving. We have something interesting going on. We may have a yields giving. At least that is what I am told. So let's see if the dramatic change in Treasury yields, mind you, it is dramatic, if the dramatic change in Treasury yields is real or is it a fake punt? Episode 98. And thank you for all your support. We are up to 230 subscribers. About a year ago, we were at zero. So thank you. If you are starting fresh, you may want to look at the playlist called the Yield and Income Investing Roadmap. That is the best way to do this show. And remember to not take what I say as any specific guidance. I'm sharing my education. Even a blind squirrel can get a nut once in a while. Do your homework. My usual disclaimers: I am not a wealth management advisor. I have no product to pitch. I don't make fees off of whatever you do. And I certainly am not endorsing any kind of policy or politics. Treasuries are indeed on the move. How about this? The blue line is April 2023. And look at what happened in 6 short months. It became the orange line, a unilateral increase in yields across all durations. We were all excited. And well, Thanksgiving surprise. November 2023, the Monday after Thanksgiving, across the board decrease in yields. Does that mean we have turned the corner? Federal funds rates are going to decrease. The economy is on the mend. Inflation has been tamed. So I thought I would go ahead and read the tea leaves and see if indeed this is a very clear sign that interest rates are falling, or is it a fake punt? Which one is it? I will share my education. Would love your comments. And so I organized today's show as follows. We'll start with our infamous yield Superbowl. Some of our wonderful listeners said they invest in a Roth IRA, that is after tax, and the portfolio grows tax free. And so we'll look at the yield Superbowl for the Roth with no tax adjustments. We'll look at the non Roth regular tax adjusted yield Superbowl. And then I was going to step back and look at what is this data really telling us and look at what else is coming in 2024 and inform my 6 month strategy based on that. So let's go to the tax-free yield Superbowl. The premise, as you may remember, is to say if you could own any fixed income instrument, which one would you own and what is the lowest risk? And we'll look at it across multiple durations. Where appropriate, I've also jumped to equities. I'm not married to fixed income. And so we'll, in this situation alone, skip talking about taxes because this is an IRA. Things grow without taxes. And the first thing that jumped out at me, if I wore the lens of an IRA investor, is that bank CDs look really, really nice across the board. Now, if the contest was only between bank CDs and treasuries, it seems like there is a very clear winner. I would pick bank CDs, except I probably wouldn't go too far on the duration side. But it is not that simple. As you know, the contest is not just between bank CDs and treasuries, it is much, much broader. So here comes the yield Superbowl. And if this doesn't mean anything to you, you should go back and watch some of the older episodes to understand how the yield Superbowl is set up. But here you go. And right away, this kind of a crowding at the beginning, treasuries are the orange curve, and I am seeing something crazy happening. Stop the press. Something is beating the pulp out of treasuries in the short term. I did not know that was possible. And yes, corporates, single A rated corporates, has dethroned short term treasuries in the IRA, meaning in the tax free scenario. You have my attention. And so I started digging deeper into each of those durations to see what is going on, because that surprised me. And so here is the first thing. I am going to start looking at the 3 month to see what is happening in the corporate bond side that is dethroning the 3 month treasury, which I thought was untouchable. I see what is happening. There is indeed a Unilever Capital Corporation, not to be confused with Unilever, the publicly traded company. This is a separate company. This provides money to the Unilever Corporation that indeed has a coupon, a bond that is trading 50 cents shy of 100. You just own it for 4 short months and out comes a 5.35% yield, which beats the 5.40. And you go, wait a second, I thought I was supposed to be making 5.55%, not 5.35%. Tring, tring, tring. Here is a call to the customer service at Schwab, and they said, oh, did we say 5.55? We really meant 5.35. What's a 0.2% yield math? We're friends. And oh, by the way, when you buy that, you also have to pay another 0.1% in fees. Oh, I forgot to tell you one more thing. If you sell it before maturity, there is another fee. And I was like, get the hell out of here. So it really wasn't beating the Treasury after all. It was less than the Treasury, even in the tax-free basis. And then I said, the 6 months should hold the key. If I owned an IRA, I should load up on 6-month corporates. How fantastic. So I started digging deeper into that. And in the 6-month treasuries for IRAs, I did see a couple of interesting things. I mean, I saw an energy company that is trading 90 cents below par. And this looks pretty interesting. I suppose if I had an IRA, I would indeed buy it. Oh, wait a second. There is that 0.1% fee to buy corporates. And once I pay the 0.1% fee, my yield all of a sudden is less than what the Treasury can pay. So sorry, folks, even in the tax-free IRA, you really don't have the advantage you thought you had in the short-term Treasuries. So Treasuries are still king in the tax-free IRA. Then I said, oh, look, in the later parts of the curve, this is astounding. The corporates absolutely blast away treasuries. I looked at that and realized, you know what, I have to dig deeper. I cannot leave this alone. So I went to this mass of investors and I asked this fantastic question. All those in favor of medium or long duration bank and healthcare bonds for very highly leveraged companies, say aye. Hello, is anybody there? Where did everybody go? Well, what I take from that is IRAs may look at corporate bonds and say they look good in the short term. Nope, not really. They look good in the medium term. Nope, not really. They look at the long term. Yep, not really. So guess what, my IRA friends? You are back to treasuries, short term. Agencies in the medium term, probably use your common sense. Whether you buy anything long term now or not is your problem. So IRAs, I have no different information for you. Treasuries are still the winner. Now let's go to the tax adjusted yield Superbowl and get a closer look. All right, the yield Superbowl. Once more, I'm reminding you, we're going to look at bonds. We're going to look at every kind of bonds. We're going to tax adjust them. FFCB, FHLB, agency bonds are going to be tax adjusted, and we're going to say which one is best. Bada bing, bada boom, here is the answer. Anything less than 9 months, treasuries crush all competition. Corporates still emerge at the 18 and 2 years, and it again piques my interest. So I'm going to go dig deeper there because we didn't look at that duration for corporates. We kind of looked at the longer duration when looking at IRAs. So I'm intrigued. I'm a little intrigued. And in the very long duration, I don't touch these right now, the 10-year and stuff like that. There are some agency bonds, but my interest again is to contradict my own theory and say, if you beat treasuries, I'm going to look at you. And so I am going to look at these 18-month and 2-year corporates and say, I want some of those amazing ones. Let me just do my homework. And so I'm going to go to the 18 months. And as you can see, even on a tax adjusted basis, there is a very clear advantage. Hey, I can pay 0.1% in fees and still get a better yield. Who are you, corporate bonds? And here comes the answer. Fantastic banks such as Credit Suisse Bank, and I don't want to say anything more about them. And you also have Harman Kardon, the owner of, JB, the headphone company, Harman Kardon Music System. These are all trading several cents below the dollar. What that also means, when they trade like that, is you're going to lose with the de minimis, you might be taxed on ordinary income, even though you have capital gains. And the other thing is, look at the minimums. You need to have 250,000 to put in play if you want 18-month corporates. And yeah, if that's your spiel and you want to invest in PNC Bank or Credit Suisse, I suppose, Harman Kardon is very intriguing. It's a fully owned subsidiary of a very stable company, Samsung. However, this particular bond is not available in Illinois. Don't ask me why. That is what it is. So nothing here made me want to jump. I'm intrigued by some of these, but buying a bank stock in the current macroeconomic situation doesn't really excite me. If it was 3 months or 6 months, I would have jumped right in. 18 months and 2 years, yeah, I'm going to wait. So then I said, okay, let me look at 2 years. What do you have for me? And a couple of things jump out. Again, extremely low prices for these bonds means you will have huge de minimis implications. Your ordinary income will jump up. And if your ordinary income is higher than a certain amount, as a percentage of your total income, even all your capital gains will become ordinary income. So be careful. You do your homework. Don't take my tax advice. Do your homework. But I personally don't like owning these penny bonds or much cheaper bonds. And I'm amused by the Citigroup bond. The Citigroup bond offers 5.7% for 2 years. I suppose that is amazing. But hey, it trades on a premium. I'm not a premium bond buyer. Notice what happens if the bond gets called, you lose 25% of your yield. How lovely. You can go buy this bond, earn 5.7%, which kind of sort of is what you can earn on a treasury anyway, and also take the risk that they will call the bond and surrender a huge amount of your yield. Not really impressed by 2 year corporates. So we're back to where we were, treasuries again. And so I said, well, how solid is the foundation for treasuries? Let me take a look. Well, I started becoming a historian, a little bit of stuff that I enjoy. And I said, I wonder what happened to interest rates leading into 9/11. And that was a very turbulent time for the country. We started with 6.24% in 2000 and drastically dropping into 2002. So great change, great turmoil does result in a rapid reduction in interest rates that happened in 2001. 2008, the great financial crisis had the same effect. We start the year in 5%, comes absolutely torpedoing down to 0.16. And you look at that and you go, ooh, am I making this mistake? Are we at the high watermark? And is that something I should be worried about? And that is something that does concern me. And then I started looking at 2020. What did COVID do? COVID started the year at 2 point something and it became next to nothing. If you bought a 3 month, 6 month, 2 year bond in 2021, good luck, you got smashed. And that is what some of the banks did, and that's why they're still hurting. And we are rapidly increasing. We're even up to 5.33 now, north of 5.33. And so the fear really is, are we going to go back to these low rates and should I lock in the higher rates? And that is where the tea leaves come in. I started gathering more of my information. And as I looked at this article, it has a very beautiful title. A third of US government debt, a third of our debt is maturing in the next 12 months. Article written 2 months ago. Well, here's what it says. Just a really cool 7.6 trillion in debt will mature in the next 10 months. And to put it in perspective, here is the amount of debt, and you can see there were 3 periods where that amount went really, really high. Ironically, those were the three periods I reviewed earlier. When that had a huge increase in 2000, 2008, and 2020, the government responded by dramatically dropping interest rates. Can the government afford to do that now? That is the real question we're trying to answer. The answer to some of it is also there in this chart. And for that, we look at the second part of it, which is what percent of debt matures within the next 12 months. And there's a difference between marketable debt, which is debt that comes for trading, and interest-bearing debt, which some of it is held by our own government. We'll look at that in a second. And so when you look at that, you also see a huge increase in marketable debt, which means this is debt that will have to be resold or absorbed. We'll talk about what that means in a second. As a percentage of GDP, it starts looking ominous again. When COVID came, our GDP decreased and our debt increased, so debt to GDP went up, but it really hasn't come back to pre-COVID levels. And that is why debt as a percentage of GDP is much, much higher today than it ever has been. We haven't had the jolt to our GDP, and at the same time, our debt hasn't decreased. So it's causing a lot of consternation. And so here is what this made me do. It made me look at, if there is all this debt coming on the market, who is buying that debt? Guess who the biggest buyer of debt is? The biggest buyer of debt is our own government. They buy their own debt by printing money and saying, well, it's no longer debt, it's money. And they put it in a different ledger and give it to the banks, put it in the economy, increase the amount of currency, which means the dollar falls. However, you had to do some of that during COVID. As you can see, we had a very nice steady stream coming into it, and COVID kind of changed the game. We had to respond. There was a big calamity. And when that mountain of new money came into the market, new quantitative easing or new money flow, it really didn't stop until lately, when some level of quantitative tightening or no easing, however you want to see it, steadied the new amount of money that was coming in. So the government did not buy a lot of that. So new debt rolled off the books, so to speak. Foreign governments stopped buying our debt, and we all sit here and say, oh my God, China is not buying or Japan is not buying. The reality is we also were not buying because we let debt roll off the books because there was so much money supply. In the middle of all of this, you see that mutual funds, banks, state pensions, all of them have a curve sloping downwards because they all said, I don't have the money to buy. The money I had is already locked into this garbage, 0.08% treasuries. I'm going to have to wait for that to mature. Sorry, government, I can't buy. Guess who is buying? You and I are buying the public share of debt, individual investors has dramatically increased from a smidgen to a bigger smidgen. And so here is what this tells me. I'm going to take my brand new high-tech binoculars, doesn't look that impressive, and try to look at what is going on. If quantitative easing is not on the cards, just go with me with that assumption, and the foreign governments continue to not buy US treasuries, that means the government isn't buying, foreign governments aren't buying, demand will be lower. If demand is lower and 31% of our debt matures in the next 10-ish, 12-ish months, what do you think will happen to yields? Think about it again. Lower demand, higher supply. It seems to me that, believe it or not, yields should go up. That is my thesis. And so I then look forward and see what else is happening in 2024. And remember that thing that I told you earlier, hey, pretend for a moment there is no more quantitative easing. Well, let me challenge myself on why that should or should not be true. There is this little minor thing going on now, really, really small thing. We have an election year coming up. Both parties want to position themselves as the savior of the poor or the, holder of fiscal discipline or whatever your position you want to take. And I don't want to pick a political side. Bottom line, one side says we have to control spending. The other side says we have to save society. This is not the time. And we are going to achieve the goals in a different way. They made different goals one way or the other. There is an election year, and we are having huge disagreements in spending. If we cannot agree on the spending bill in the next 3 months, by the time the next administration comes to power, then we are going to have huge cash needs because of debt maturing. We could print money, but that means there is going to be quantitative easing and more inflation. We can say, I'm not going to print money, but that may lead to a recession and or a default. We can say, well, let me decrease the reasons why we are spending money, and that would affect social structure. Let me put it this way, I'm happy I'm not running for president. I can't. But I don't envy the new government in 2024 because they do not have easy choices at all. Interest rates are unlikely to come down short of a catastrophic event, is my read from all of this. Based on that, what is my 6 month strategy? Yes, very nice. Yes, I understand that from April to October it was a meteoric journey up, and all of a sudden it looks like it is coming down. I have read the tea leaves, and I am calling fake punt. I will not be increasing duration. I am still going to stay with short term treasuries. I expect some bumps in February of next year, and my sense tells me that there may be a yield event and I will jump into value equities if there is one. Otherwise, I am still going to T-bill and chill. Thank you for listening to Yield Nerd. Do your own research.